Business buyers pay too much and business sellers don't get enough because they don't know how to value a business. Valuabusiness.com.au, you might only get one chance to get it right.
Business valuation made easy. The Future Maintainable Earnings Method. Valuing a business is easy. All you need to know is what is the profit and what you multiply that profit by to get to the business value. How easy is that? Now, finding the profit is not so straightforward. Profit means different things to different people, different accountants. Are we talking about what the owner gets out of the business, or are we talking about what the owner gets after all wages for staff, including his own, are deducted? Let's look at each scenario. If it's the first one, owner's return, then the multiple is different to the multiple you use if you're multiplying genuine profit. That is profit after owner's wage deducted, which is called EBIT, earnings before interest and tax. The multiple of EBIT is obviously going to be smaller than the multiple of owner's return for the same business. That stands to reason because EBIT is a smaller number, and for the same business will attract a higher multiple to get to the same result for that business. It's just mathematics. By the way, if the business has no profit and not enough return to owner to justify this type of profit valuation, you are left with valuing the business according to the value of the assets. Now, once we know what profit is, we're going to apply the multiplier. Which multiplier? If we are multiplying owner's return, the multiple to use ranges from 1 to maybe 2. Remember, a smaller multiple. If you are multiplying EBIT, then the multiple range is larger, approximately 1.5 to 3. Bigger multiple. It has to be a good business to get a 3 at this level of small business. So what types of things increase the multiplier? It's risk. Basically, if it's a less risky business, you get more money for it. Things like having a manager, having good systems, having a good client base, not being reliant on the owner, not being in a dead industry, all these things will boost the multiplier. A good valuer will check his result against prices that are paid in the market for similar businesses. This is called a sanity check. What mistakes do people make in simple business valuation, accountants included? Well, applying the wrong multiple to the wrong profit, getting the multiplier wrong, valuing the business according to the above formula, then adding the value of equipment and stock on top, which has the effect of way overvaluing the business. Forgetting to consider the capital you need on top of the business price, for example, to pay rent, buy stock, maybe put up a bond, and other working capital needs. This must be part of the investment as capital is tied up and could be utilised elsewhere if it weren't for the business.
Valuabusiness.com.au when you really need to know what a business is worth.
We said future maintainable earnings, remember? History is a good guide, but it's only a guide. And for more info on valuing the business, go to valuabusiness.com.au. We've got all the answers there, but you knew that.
Find out what a business is really worth and visit online at valuabusiness.com.au.